You think that new credit card with the great rewards is a smart financial move? A sign of your success, maybe? A tool for convenience? Well, what if I told you it's a carefully designed psychological trap? That card in your wallet isn't just a piece of plastic. It's the result of decades of behavioral engineering, all designed for one purpose: to keep you spending and to keep you in debt. And the most shocking part? It's working. As of late 2025, credit card debt in the United States alone has soared past $1.2 trillion. That's a stack of $1 bills that would stretch an incredible distance, more than a third of the way to the moon. We see the ads, we celebrate the cashback, we chase the travel points. We believe we're the customer, the one being served. But in this vast, multi-trillion-dollar industry, if you're not paying for the product, you are the product. More specifically, your debt is the product. This isn't a story about personal failure or a lack of self-control. This is a story about a system meticulously crafted to exploit the very wiring of the human brain. It's a system that has turned the simple act of paying for something into a sophisticated form of psychological warfare. The question we need to ask isn't just, how do I pay off my debt? But how did we even get here? Are you really in control of your spending, or are you being controlled by a system that was designed for you to fail? The truth has been hiding in plain sight, buried in the fine print and in the habits we've been taught to accept as normal. And today, we're going to expose it. We think of the credit card as this icon of modern convenience, a natural evolution of money. But it wasn't born from a simple need for convenience. It was born out of a moment of social awkwardness, and it was engineered to do one thing masterfully: to remove the friction of spending. The story, maybe polished up a bit by a clever PR team, starts in 1949. A businessman named Frank McNamara is at a dinner in New York City when he realizes, to his horror, that he's forgotten his wallet. His wife has to come rescue him and pay the bill, but the experience plants a seed. McNamara decided he would never face that embarrassment again. A year later, in February 1950, he returned to that same restaurant, Major's Cabin Grill, and when the bill came, he paid with a small cardboard card. That event, hailed as the first supper, marked the birth of the Diners Club card, the world's first multi-purpose charge card. The concept itself was simple. Diners Club would act as a middleman. Instead of individual stores offering credit to a few loyal customers, this one company would offer credit for many different businesses, then bill the customer at the end of the month. In its first year, it grew to 10,000 members among New York's business elite. Merchants paid a 7% fee to accept the card, and in return, they saw more business. It just looked cool and professional to pay with a card instead of fumbling with cash in front of a client. But notice the real innovation here. The point wasn't to make payment possible. Cash already did that just fine. It was about making payment painless. It was about separating the immediate pleasure of a purchase from the delayed, bundled-up pain of the bill. Before the Diners Club card, every purchase had a moment of friction, the physical act of counting and handing over cash. You felt the loss in real time. The charge card replaced that friction with a smooth, effortless signature. The pain was put off, rolled into a single abstract number that wouldn't show up for weeks. This was the first step in creating a financial anesthetic. The original Diners Club card was a charge card, which meant the balance had to be paid in full each month. It was a tool for deferral, not debt. But the real revolution, the moment this tool of convenience morphed into a machine for mass indebtedness, happened 8 years later. In a quiet city in California's Central Valley. It was 1958, and Bank of America was watching the rise of these charge cards. They saw an opportunity, but with a critical twist. What if instead of requiring the balance to be paid in full, customers could carry a balance over month after month and pay interest on it? This was the birth of revolving credit. To test this game-changing idea, they chose Fresno, California. Fresno was a self-contained market where Bank of America held a 45% market share. If the experiment blew up, it wouldn't create the kind of bad press it would in San Francisco or LA. What happened next is now legendary in the financial world. It's called the Fresno Drop. On September 18th, 1958, Bank of America mass-mailed 60,000 unsolicited, pre-activated Bank Americards to households all over Fresno. No applications, no credit checks. One day, thousands of families just opened their mailboxes to find a piece of plastic that gave them an instant line of credit, usually for $300 to $500. A pretty big deal at the time. It was the moment, as journalist Joseph Nocera wrote, that the American middle class began to change the way it thought about and dealt with its money. The initial result was a total disaster. Delinquency rates shot up to 22%, way higher than the 4% the bank was used to on traditional loans. They lost millions. The guy who dreamed up the program, Joe Williams, hadn't even set up a proper collections department, and he resigned. But the bank didn't give up. They tweaked the model, learned from their mistakes, and within 3 years, the program was profitable. That Bank Americard, born from the Fresno Drop, would eventually be licensed to other banks and in 1976 be renamed Visa. The Fresno Drop was the point of no return. It established the business model that dominates our lives today. Issue credit far and wide, encourage people to carry a balance, and get rich off the interest. Mailing unsolicited credit cards was later outlawed, but the genetic code of the industry was already written. It was no longer about helping the elite avoid embarrassment. It was about providing a product to the masses to generate debt. The transition was complete. The credit card wasn't a tool for convenience. It was a leash disguised as a luxury. The convenience was just the bait. The real product was the debt itself and the interest it would rake in for decades. If the history of the credit card shows us the intent behind the system, then understanding the psychology reveals the mechanism. This isn't just a financial tool. It's an instrument of psychological influence, precision engineered to exploit our cognitive biases and short-circuit the rational part of our brains. The companies that built these systems understand your brain better than you do. They know what drives you, what you fear, and exactly how to nudge you into making decisions that benefit them, not you. This is the psychological warfare happening inside your wallet every single day. The first and most powerful weapon they use is the numbing of what economists call the pain of paying. For most of human history, spending money meant a tangible loss. Handing over coins, bills, or any physical token of value triggers a small negative response in the brain. Neuroscientists even found where it happens. Using fMRI scans, they've seen the insula, a brain region linked to pain and negative feelings, light up when we buy something. It's that little voice in your head asking, "Are you sure? This is going to cost you." But credit cards act as a powerful anesthetic for that feeling. The simple, frictionless swipe of plastic or the tap of a phone doesn't feel like a loss. It's abstract, distant. As neuroeconomist George Lowenstein put it, the nature of credit cards ensures that your brain is anesthetized against the pain of payment. The most famous proof of this comes from two MIT professors, Drazen Prelec and Duncan Simister. They ran a real-world auction for hot-ticket Boston Celtics basketball game. They told half the bidders they had to pay with cash, and the other half had to pay by credit card. The results were staggering. The average bid from the credit card group was nearly twice as high as the average bid from the cash group. Same tickets, same people, same desire. The only difference was how they paid. The credit card didn't just make the payment easier, it made people willing to part with way more money. It short-circuited their sense of cost. More recent fMRI studies from MIT took this even further. They found that using a credit card doesn't just release the brakes by reducing the pain of paying. It also steps on the gas. Researchers saw that the mere cue of using a card activates the brain's reward center, the striatum, the same dopamine pathway that gets a hit from things like delicious food and addictive drugs. The card itself becomes a trigger, creating an anticipation of pleasure before you even buy anything, driving the motivation to spend. You're not just buying a product, you're getting a small neurological reward just from the act of using the card. This leads right into the second psychological trick, the illusion of wealth. When you look in your wallet and see a $20 bill, you know you have $20. Your resources are finite and tangible. But when you look at a credit card with a $10,000 limit, your brain doesn't see that as a $10,000 loan. It sees it as $10,000 of spending power. That abstract number creates a false sense of wealth, making purchases feel less significant. The number on your statement isn't real money leaving your account, it's just a digit changing on a screen. This abstraction makes it far easier to justify impulse buys and overspending because the link between the action and its consequence has been severed. And to make sure you keep on swiping, companies perfected the third weapon, the rewards program. Cashback, travel miles, loyalty points, these are not gifts. They are carefully designed behavioral incentives based on the principles of operant conditioning, a theory from psychologist B.F. Skinner. Operant conditioning is simple but powerful. Behavior that gets a reward is more likely to be repeated. Every time you swipe your card and see 2x points on dining or 1.5% cashback, your brain gets a small pleasurable reward. This positive reinforcement trains you to associate spending with pleasure, creating a powerful feedback loop. You're not just buying dinner, you're earning something. Spending is no longer a loss, it's a gain. It becomes a game. And the companies are masters of this game. They use tricks like the endowed progress effect, giving you a sign-up bonus to make you feel like you're already on your way to a goal, which makes you more likely to keep spending to hit the next tier. They frame rewards as challenges. Spend $3,000 in 90 days to earn 50,000 bonus miles, creating a sense of urgency and turning your spending into a quest. The danger, of course, is that people start overspending just to chase these rewards. They'll spend $100 on a meal they wouldn't have otherwise bought, just to earn $2 in cash back, totally ignoring that if they can't pay the bill in full, the interest will white out the value of that reward many times over. The whole system is designed to change your behavior and get you to spend more, all while making you think you're getting something for free. Finally, we get to the most insidious trap of all, the minimum payment. On every credit card statement, by law, there's a box that shows you how long it will take to pay off your balance if you only make the minimum payment. Most people ignore it. They really shouldn't. It reveals the dark heart of the entire business model. The minimum payment isn't designed to help you get out of debt. It is designed to keep you in debt for as long as possible. The calculation is sneaky. The minimum is usually a small percentage of your balance, often just enough to cover last month's interest plus a tiny fraction of the principal, around 1 to 2%. Because the payment is a percentage of the balance, as your balance slowly goes down, so does your minimum payment. This creates a financial treadmill that feels impossible to get off. Think about this. The average credit card debt for those carrying a balance in the US is around $7,321. The average interest rate for those accounts is a staggering 22.83%. If you had that balance and only paid the minimum each month, it would take you decades to pay it off. For example, a £3,000 debt at a typical 21.9% APR would take 28 years to clear if you only make minimum payments. And you'd pay over £4,750 in interest, more than the original debt itself. You're running on a treadmill, putting in effort every month, but the finish line just keeps moving further away. The system monetizes your hope, selling you the illusion of progress while chaining you to a cycle of perpetual debt. From numbing the pain of paying and creating an illusion of wealth to gamifying your spending and trapping you on the minimum payment treadmill, every single part of the credit card experience has been optimized. It's a psychological masterpiece designed not for your convenience, but for their profit. They've turned your own mind against you, and it's a battle most people don't even realize they're fighting. If the psychological tricks are the soldiers on the front lines, then the business model of the credit card industry is the command center running the whole show. We've been led to believe that we, the card holders, are the main customers. But that's a carefully constructed myth. The industry runs on a complex system where money is squeezed out at every possible turn, not just from people in debt, but from everyone, including merchants and even people who pay their bills on time. It's a financial extraction machine, and its efficiency is breathtaking. The first layer of this machine, and the one most people never see, is interchange fees. Every single time you swipe, tap, or insert your card, the merchant, the coffee shop, the grocery store, the online retailer has to pay a fee to process that transaction. This is called an interchange fee or a swipe fee, and it's usually a percentage of the purchase between 1.5% and 3.5% plus a fixed per transaction fee. This might sound small, but it's a gigantic source of revenue. These fees are collected by your bank, but are set by the card networks like Visa and MasterCard. For merchants, these fees are a major cost of doing business, often adding up to thousands of dollars a year. And where do you think that cost goes? It gets passed on to you, the consumer, in the form of higher prices on everything you buy. This means that even if you're a diligent cash-only user, you are indirectly subsidizing the credit card system. You're paying for the rewards and convenience of card users through inflated prices. The entire economy has been re-engineered to feed this machine. Card companies have even found sneaky ways to maximize these hidden fees. One of the most deceptive is called dynamic currency conversion, or DCC. When you're traveling abroad and use your card, the terminal might offer to convert the transaction into your home currency on the spot. It sounds helpful, but it's a trap. By accepting this supposedly helpful offer, you're letting the merchant's bank use its own highly unfavorable exchange rate, which can be much worse than your card issuer's rate. It's a hidden charge presented as a helpful choice, but it only benefits the processor. But as huge as interchange fees are, the real profit center of the industry is you, or more specifically, your balance. The industry splits its customers into two groups, transactors and revolvers. Transactors are people who pay their balance in full every month. Companies make money from them through interchange fees and annual fees. But the customers they really value, the ones their entire model depends on, are the revolvers, the people who carry a balance from month to month. For them, the interest charges, or APR, become the primary engine of profit. As of late 2025, the average APR on credit cards that are carrying interest has climbed to an astonishing 22.83%. New card offers are even higher, averaging over 24%. These aren't rates for high-risk borrowers. These are mainstream rates for average people. To put that in perspective, if you took out a traditional loan at 23% interest, it would be considered predatory. But on a credit card, it's become standard. The compounding nature of this interest means a balance can quickly spiral, with interest being charged on top of previously accrued interest. This is how a $2,000 purchase can easily end up costing you $4,000 or more. And for anyone who makes a single misstep, the system has a trapdoor waiting, the penalty APR. If you miss a payment deadline by even a day or have a payment returned, your issuer can, and often will, jack up your interest rate to a penalty level, which can legally go as high as 29.99%. Imagine your interest rate suddenly jumping from 22% to nearly 30% overnight. because of one little mistake. This isn't just a penalty, it's a catalyst designed to speed up your descent into deeper debt. The higher rate means a higher minimum payment, making it harder to catch up, which can lead to more missed payments, wrecking your credit score, and locking you in a cycle that's nearly impossible to escape. On top of all that interest, the industry has a whole buffet of fees designed to extract money at every opportunity. There are annual fees, which can range from $50 to over $5,000. There are cash advance fees, typically 3 to 5% of the amount, plus a separate, even higher interest rate that starts ticking the moment the cash is in your hand, with no grace period. And there are balance transfer fees, late payment fees, returned payment fees, and over-the-limit fees. Each one is a small paper cut, but together they can cause you to bleed out financially. This entire ecosystem, the hidden fees that inflate prices, the sky-high interest rates that trap revolvers, the tripwire of the penalty APR, and the endless list of add-on fees, is not a series of unfortunate bugs. It is the core feature. The system has been deliberately designed for you to fail, or at the very least, to struggle. Because in the logic of the credit card industry, a customer who is perpetually in debt is the perfect customer. Your struggle is their business model. Your financial anxiety is their profit margin. They haven't created a tool for your convenience. They have created a system that profits from your debt. After walking through this dark maze of psychological manipulation and predatory business models, it's easy to feel overwhelmed, angry, or even hopeless. The usual advice here would be a checklist. 7 tips to pay off debt faster, or best budgeting apps of 2025. But that advice, while well-meaning, misses the whole point. It treats the symptoms, not the disease. Giving someone budgeting tips to fight a multi-trillion-dollar industry is like handing them a bucket to fight a tsunami. The real solution isn't a list of steps, but a deep shift in your mindset. It's about moving from unconscious consumption to conscious awareness. The system is designed against you, yes, but its power comes from your ignorance of how it works. Its greatest weapon is the fact that you've been playing a game without knowing the rules, or even that you were a player. The first, most powerful step is to simply understand the game. Awareness is the beginning of control. You now know that the convenience of a credit card is an illusion, engineered to numb the pain of paying. You know that rewards programs aren't gifts, but tools of conditioning meant to make you spend more. You know that the minimum payment isn't a helping hand, but a treadmill designed to keep you in debt for decades. You know that your debt isn't just a personal problem. It's a profitable asset for a massive financial system. This knowledge is your shield. It lets you see the card in your wallet, not as an extension of your buying power, but as what it really is. A high-interest loan agreement wrapped in slick marketing. It's a tool of a system that profits when you carry a balance, when you're late, when you slip up. So the path forward isn't about cutting up your cards in some dramatic gesture. For many of us, they're a necessary tool. Instead, it's about learning to use this tool with intention and a healthy dose of suspicion. The solution is to reintroduce the very thing the system was built to eliminate: friction. Friction is that pause between desire and action. It's the moment of conscious thought that Tap to Pay is designed to erase. You can reintroduce this friction in simple, powerful ways. Try a cash week. For 7 days, use only physical cash for all your discretionary spending. Coffee, lunch, groceries. Feel the tangible loss of money leaving your hand. Watch your wallet get lighter. The experience is often a shock to the system and will recalibrate your internal sense of cost better than any spreadsheet. For bigger purchases, create a mandatory 24-hour rule. When you feel the impulse to buy something non-essential over, say, $100, just stop. Wait 24 hours. The emotional dopamine-fueled desire of the moment will often fade, letting your rational brain take over and ask the important questions. Do I really need this? Can I truly afford it? What else could I do with this money? Look, this isn't about depriving yourself. It's about being deliberate. It's about changing your perspective. True financial control isn't having a high credit limit. It's understanding the system so well that you can use its tools without falling into its traps. It's about making choices from a place of awareness, not from a place of engineered impulse. They designed the trap, but this knowledge is the key. You now hold that key. The power dynamic has shifted because you're no longer an unwitting participant. You're an informed observer, capable of making conscious choices that serve your interests, not theirs. We've traveled from a fateful dinner in 1949 to the trillion-dollar global industry we have today. We've seen how a simple idea to avoid embarrassment spiraled into the Fresno Drop, and then into a sophisticated system of psychological manipulation and debt monetization. The piece of plastic in your wallet is the end result of this history, a product engineered to separate you from your money as painlessly as possible, while profiting as much as possible when you can't pay it back. The truth about credit cards that everyone ignores is that they are not on your side. They are tools of a system that has become one of the most effective wealth transfer machines of our time, moving money from the pockets of everyday people to the balance sheets of financial giants. The feeling of being trapped in debt is not a personal failure. It is the designed outcome of the system working exactly as planned. But this knowledge isn't a reason for despair. It's a reason for empowerment. You are now aware of the game. You see the hidden fees, the psychological nudges, and the debt traps for what they are. So the next time you pull that piece of plastic from your wallet, take a breath, look at it, and ask yourself a simple, powerful question. Is this tool serving me, or am I serving it? If this video opened your eyes, and you want to continue exploring the hidden systems that shape our financial world, subscribe for more deep dives into the truth about money. And let us know in the comments, what was the most shocking truth you learned about your credit card today?